I just want that music to last forever, Jason. I just want it on loop. Maybe we can like do it in the background quietly. It would really just keep this whole thing just at a whole other level.
Maybe we should just do it for the entire hour. It'd be more entertaining than us talking.
I know. Welcome, everyone, to the Pirates of Finance. This is the show where we talk about pretty much everything but finance lately. Definitely not finance. Finance. We've been talking about, I don't know, TikTok, influencers, crypto, really anything but the major headline economic stories, because frankly, we really don't care about them. But look, before we get started, this show is absolutely not advice. Whether you're watching in real time, watching later, listening later, none of this is advice. You're listening to two random dudes on the internet spouting nonsense. You should fact check us. You should talk with someone who actually knows what they're talking about before you make any investment decisions. Really, this is just a good life policy. Honestly, if you're getting your advice from random strangers on the internet, hit the pause button, rethink a few things, come back to us, and then engage in the conversation. But that's where we're at. This is absolutely not advice. Now, before we get going, a little update here on the Pirates side, Jason. I want to throw out a little shout out to Tyler behind the scenes, who, by the way, makes this whole show work. Those of you who have been with us for a while will now see that the intro and outro run very smoothly. It's because Jason's not doing it anymore. It's all Tyler. But I'm very excited for Tyler because he is now officially part of a domestic partnership. And that is very exciting stuff, you know, to get tied down like that in a legally binding manner with none of the celebration. Really, just golf clap. Golf clap for Tyler.
It's a dangerous thing for me to learn too, because then he could get the insurance benefits for his significant other. So like
there's all sorts of benefits to the domestic partnerships. And when I originally looked into it, my understanding is that the rules are state by state. So when I looked into it when I was living in Massachusetts, I believe the rules were you had to live with the person for 7 years and provably show you lived with the person for 7 years. Versus New York, when I looked at the rules, it's like very flexible. It's like as long as you intend to stay together, great, you could have just moved there. So phenomenal, financial decision, Tyler. And honestly, from everything I know about your partner, she is too good for you. She's really too good for anyone. So well done. Well done.
And then for those that don't know, he's gonna kill me now. We were just talking about this when you were off air. Is like they're the cutest little couple in the whole world. They just make me smile.
They are very cute. Very cute. Good choice. So here's where I want to start off, Jason. I have a bit of a confession to make. I was out with my wife last night. We had to run some errands. We stopped by a little market near us, and I spied upon the shelf something out of the corner of my eye that caught my attention, and it was pumpkin spice Cheerios. and I just had to have it. I had to know. It was like the forbidden fruit of fall consumerism.
This is the signifier of you going into suburban dad mode, right? You're gonna have a kid.
This is where it gets better. Then I had this is where it got better. I got a brilliant idea. I saw some chocolate chips as well, some dark chocolate chips, and I said, here's what I'm gonna do. I'm gonna go home, put a little pumpkin spice Cheerios in a bowl, put some chocolate chips in there, shake it up. I made my own tasty little snack. And honestly, it was not that bad. I expected them to be disgusting. As someone who comes from New England, who gets bombarded with pumpkin-related things over the last decade, as soon as it turns September, I was expecting it to be like treacly, sweet, gross, sugary. It was a nice touch of pumpkin. They did a good job. Kudos to Cheerios.
Dude, I cannot believe it. This is you couldn't have said something more shocking to me. Did you go into like a diabetic shock after that? Because that's like out of the norm for you. Or like a good person with body dysmorphia, you went on a 10-hour run after to burn off all the calories.
No, I think this about me is that the only reason I work out is to eat. Exactly. Like that is the soul. I have such a sweet tooth that I inherited from my mother. She doesn't eat cakes and pastries and all that sort of stuff. She is like pure candy. Incredibly fit woman, but just like loves candy. I inherited that, but also I love cakes and pastries. Really, just you put any sort of dessert in front of me and it's game over. So the way I live my life is I keep it out of my house.
Yep.
Otherwise, I will eat it. It's incredibly frustrating to me when my wife buys a pack of Oreos, just eat 2 Oreos and leave it in in the cabinet for 2 months. I don't understand how that's physically possible. So yeah, I just eat it all and then I body shame myself with some intense work. Very helpful.
This Halloween candy is killing me, but also like you're saying with like just having it in your house, I've always tried to teach my girlfriend that everybody knows that an ice cream pint is a single serving. You don't need to put that in a bowl. That's just for one sitting. That's why you don't have it in your house. And I just want to shout out to the Booty Crew, seeing the comment here. Last night, shout out to Sean. We in-person Booty Crew meetup in IRL. It's nice to always do that stuff. See Jeff Malik is in here for once live. It's good to see old Jeff in here. And I can't even comment on Greg's comments about both of us, but like I will say, I do notice every week, and I hope everybody else does, how passive aggressive you are about like the headspace between us. You're just showing your height dominance. You're always pulling that mic closer. Just we've talked about this, Corey. We've talked about this.
No, what we've talked about is that I have no capacity for doing this correctly. Is that you actually understand how to set up a camera. You have a nice camera. You set up lighting. I find the nearest window and throw this together in 2 minutes. You are perfectly framed. I'm like constantly leaning forward and back. My mic noise is going up and down. Yeah, we've just accepted one of us knows what they're doing. The other is just fumbling their way through this series.
Yeah, and as per usual, we decided 30 seconds before we'd maybe talk about trend following on this episode. I want to touch on another few things first. One, talking about the Booty Crew is like we need to maybe. I was thinking, how do we do this? Is like talk about like when we're traveling around the country and everything. Is trying to create some like Booty Crew meetups or something. Little pirate treasure hunts or something like that. Because maybe it's too late, but I'm speaking at EQD in Miami next week on the 9th. And I might have a little bit of time in the late afternoon, evening, if anybody wants to do a meetup in Miami. But I'm in and out because then Corey and I are at a private event speaking in Cayman the 10th through the 13th. Unfortunately, we can't really do any meetups there because we're kind of busy with that private event. But in future, we need to really think about how we kind of put our schedules out there to maybe do some meetups, because that's always, a good time to take this from this digital space into the meet space.
Yeah, it went from post-COVID not traveling to I'm back on the road very frequently. Hence the mixed schedule. Yeah, it was very nice break there for a while. And I got to tell you, I hate airlines again. Here's a big switch for me, pre-COVID, post-COVID. Okay. I don't know if you noticed this. So pre-COVID, I was living in LA, and just through a variety of events was a frequent flyer of Alaska Airlines. Very random, I know. But that's just how things ended up. And I was sort of a premier tier. And the nice thing about Alaska was that who the hell has status on Alaska?
I do. No, it's worthless.
Oh, actually, I thought Alaska had really nice planes because they bought Virgin. So they got all of Virgin America's planes, which are brand new. So they
grounded all of them. It was a bait and switch.
I know. During COVID, it got ugly.
I'm angry.
I know. But status on
Alaska. It was the easiest way to earn points, though, too. You could rack up points, though. I'll give them that. Like, you could really use points on Alaska.
You could rack up points, but also I got upgraded to first class every other flight.
Yeah,
50% of the time. Now that I am living in an area in Florida where Alaska doesn't fly, first of all, my status on Alaska is meaningless. I haven't flown Alaska in 2 years, so I'm back down to the bottom status. And I have now started earning status on American, quickly up to sort of like gold status, which means dog shit on American, especially flying out of Florida, where like everywhere in the world allows those who have disabilities and military to board first, the elderly. Well, that's all there is in Florida. Like when they call anyone who needs assistance to get on the airline, it's 40 people in wheelchairs getting on before me, which is fine. They should get on before me. But why do I have status? It doesn't matter. And so I'm gold status. I will never get upgraded. Because it's like, yeah, I'm gold status. I am like literally the worst status you can have because they've got like gold, platinum, triple ruby, private experience, black diamond card. Like it's just absurd. And so, no, I will never get upgraded. I hate flying again. The planes are packed. We're in this shitty like pro-cyclical cycle of the flying sucks, so no one wants to do it. So they're not increasing the number of flights, so flying sucks. Like,
well, that's for once for once I get to flex on you because I got Ruby status on American, so I actually have a pretty decent experience every time I get upgraded often. And I want to shout out Phil Brick's in here, man. Shout out to Phil Brick. But speaking of American, though, I love this part though, like you just said about trying to get somebody on American on the line. Is Adam, reached out and was asking if I could stay longer when we were in Cayman to like do an event with them, and I wish I could, but part of my first inclination was like, I don't want to have to fucking call American to read a ticket because it's a Cayman ticket, so you can't do it online. And I was just like, so the pain, and obviously that's not going to be the reason I didn't stay, but I was like, that was my first inclination because you're talking about American. It's like, I do not want to be on the phone with American today. This will be all day scenario, and it's just nightmare. The other thing we haven't talked about in a long time, we haven't talked watch talk in a long time, because obviously the watch market's tanking. So that's obviously why it's not as fun to talk about. But just a few things kind of popped up recently. I was texting you the other night that watching the Phillies game, old Roman Sharf from Luxury Bazaar was at the Phillies game. So it was great to see him. It's been, they haven't been producing as much content either on YouTube as maybe why we haven't had as much watch talk. But the one that blew my mind was Kevin Rose was on My First Million. And they started talking about Hodinkee. What do you guess the annual revenue of Hodinkee is?
That's a really good question. Because let's talk about Hodinkee's. For those who don't know, Hodinkee is a great sort of consumer watch brand. They've got, I think, a physical magazine, strong digital presence, tons of videos, podcasts. They resell watches. So I would have to imagine, they are like, for watch connoisseurs, like the premier source, really. I would have to imagine advertising revenue is probably where they make most of their money. I know they do like vintage resale and resale, but I don't like, you compare their inventory versus someone like a Watchbox or a Luxury Bazaar. It's not even close. So I can't imagine they're doing tremendous volume there. And I don't know if they do shows like the way, a Roman Sharf would do a show with Luxury Bazaar where they go to Miami for all the watch shows. But I bet advertising, they make a lot of money. Like, they've got to be, I want to, this might sound absurd, I want to put them north of 25 million in revenue.
Absurd, huh? $100 million annually.
Yeah, you want to know what? Luxury Bazaar is like 100 million annually,
but they're actually like selling, like you said, it's more on the merch side and the vintage side. I also think what you missed, I think they do have some like AD relationship now, kind of too. They could sell online, but like I think, but when Kevin merged, because what was his like Farmville or Watchville, when he came over to Hodinkee, that's when they merged, and they were only doing like, I think under 1 million, I think, an annual run rate. And then like that merging and then rebranding and then doing all these different business lines. Yeah, $100 million a year with a watch site. Like I'm
always curious with some of that stuff though. Like, again, revenue versus profit, right? A lot of this watch game, these people who are doing 100 million in revenue, like that's still incredibly impressive. Don't get me wrong. The number of watches you have to sell to get to 100 million, but the margins there aren't like super big most of the time.
Are you trying to get me on an epic rant? There's nothing I hate more than people that quote gross revenue. It's so annoying. It's like, what are we even talking about? Because especially in like the ecom game or Amazon FBA game, you could goose all of your gross revenue and actually be, net losing money or net, cash flow negative. You're actually, because you could do anything you can to improve revenue, but everybody loves talking about gross because of our egos. But like, let's talk about net. And especially in our game, people here are like, hundreds of millions of dollars in assets under management. We're like, yeah, that equates to 50 grand a year. Congratulations. Yeah. But everybody wants to talk about the headline number because it boosters our ego. But yeah, let's talk about net. But yeah, it would be interesting.
Well, I was see what their net was. TikTok yesterday, and there was a live event of an Amazon reseller, and he was doing a Q&A. And so I tuned in for a little bit. And one of the questions was, what's your revenue versus what's your profit? And he was very transparent. He said, I do over $1 million a year. And my profits of it's like a 20% take home, right? Like the cost of goods there are pretty high. Cost of shipping is high. And so you could do $1 million of revenue and take home 20 grand a month, which is, again, nothing to laugh at, but it's very different than $1 million.
Yeah. And then all your money's tied up in inventory. I'm curious though, when actually, when you said you had a surprise.
This has gone so far off what we intended on talking about. We're like, we're going to talk about trend following.
We'll come back to it. This is a downtrend. And then when you were talking about, you were looking at the shelves the other day, I thought you were going to say, you do what I do now. Whenever I'm at restaurants or even in grocery stores or anything, I'm looking at all the rum brands and looking at their bottles, their labels, their packaging, their price points. Do you catch yourself doing any of that now?
I don't need to because I've had all of them before.
They're gonna say I don't need to because I let you take care of that. I'm the taste tester.
Well.
I'm quality
control.
As
well. No, I actually I haven't restocked my liquor cabinet to this place I just moved into, so I haven't really gone and looked at liquor around here. I did pick up a quick bottle of rum, and it was, I will say, a very cliche offering of rums at this liquor store I was at. I was very disappointed because they had some very high-end bourbons, really interesting scotches, and then the rum collection was just like your very cliche mid-tier, nothing interesting, which I think is, again, makes that part of the industry ripe for disruption. And we're certainly not the first to think of it. But I think there's a brand perception issue with rum, right? People think of rum as Captain Morgan, and it's certainly a lot more than that.
Exactly. So we'll get to the trend following now. So why we came up with this topic is at EQ Derivatives next week, I'm doing a panel on trend following. And so I was working on some questions kind of throughout the week we could talk about on the panel, and realized that my questions were maybe way too detailed and way too in the weeds for the audience, because the audience is more family offices, kind of allocators on that side. So it's more about like, the classic stuff like, do you add trend to the portfolio? Should you add trend? Are you performance chasing trend right now? How much to add to trend? So I had much more like technical questions. So I'd love to kind of just like rapid fire, not really rapid fire, but pick your brain because I got a bunch of them, and we'll see what kind of comes out of it. And starting the first one that I think is interesting is, as you know, how big the energy complex is for trend following. And I really wonder, do we have a put on oil with SPR at $72, which they're claiming they'll buy it? But I also think it's a collar, actually, because if they're putting on excess profit taxes on gains to the upside, are we collaring energy and oil specifically? And how much would that possibly affect trend following if you're limiting the trends and you're basically creating a mean reversion scenario on the energy complex?
Yeah, so this is an area where I will proudly confess I have very little true fundamental knowledge. But I think there's always interesting dynamics at play in these commodity markets where you actually have true fundamental supply and demand, and then you have speculative supply and demand. And I think where trends really begin to emerge is when that fundamental supply and demand gets offside and breaks. So you could see, in my opinion, like this enforced fundamental mean reversion in a commodity that in many ways may only act like a coiled spring for a significant trend if one of those fundamental players is forced to capitulate, because that will cause the emergence of that trend. So yeah, and I think that's what makes these markets particularly interesting, right? These aren't just pure speculative markets. No markets in theory are, but the supply and demand side, where there's producers and consumers that are participating in these markets that have real needs that are going to be forced to capitulate at certain prices or have impacts on their business that forces them to trade. I think it allows markets to, potentially bounce between in this mean reversionary behavior. And then when it breaks at a very significant way that causes the trends to emerge. So, you might argue this is a potentially horrible trade while the mean reversion is at play, but you don't know when it's going to break, if it's going to break. And so you just sort of have to eat the whipsaw and be diversified and hope that the trend that does eventually emerge more than pays for the whipsaw cost.
No, it's a great way of putting it. And then when it does break, it depends on the speed at which your signals, generate, and the speed at which you trade, and how quickly you'll capture that breaking move. I wonder, I don't know if you and I ever really talked about this, but I always want to know like how things work or why things work. And I've always found trend following lacking. At least the older generation of trend followers are always like, well, trends happen because humans have behavior, and we're basically behavioral mapping. And I'm like, it's kind of true. But like, I tend to more agree with my buddy Eric Crittenden that it's another form of risk transfer services. Like, like you think about like long short portfolios all the way down. I think about like risk transfer services and harvesting inventories of risk and doling those out to market players. And so you're hedging, the actual producers on the commodity trend side. On the volatility side, you're inventorying risk for people. So it's a very clear risk transfer services. So I just wonder, almost in that sense, is like, especially when, if a government steps in and you have this exogenous factor at play, are they now taking over the risk transfer services? So then therefore you're almost like losing trends to that market. Like you said, it can obviously break, and, like as we've seen, currency pegs break and everything like that. is like those are one of those concerns you should have as a trend follower, or as Eric has put it too, is like the thing that would kill trend following is vertical integration, right? Like if Amazon vertically integrates their entire supply chain, they're not going to look for hedgers and to build out that speculative side of hedging, so they have the risk transfer services. So I wonder, in this place, when you have government stepping in, is it a similar kind of scenario where they're taking over the risk transfer services that typically the trend followers provide?
So I tackle this two ways. And by the way, I love talking about, first of all, trend following is near and dear to my heart. It's been something I've been doing for the last 14 years. So it's something I'm very passionate about. And this year in particular, I think is finally proving that multi-asset trend hopefully does deserve a spot in your portfolio, or at least a consideration for evaluation. Probably people getting out a little too over their ski tips and adopting it without understanding it, as happens in these cycles. But it's a very exciting time, I think, for trend following after a very tough decade. So the way I tackle this question is sort of, first, I think about it. I love the risk transference concept, by the way, because I love to say risk can't be destroyed, only transformed. So that's one near and dear to my heart. But the way I look at this first and foremost is mechanically, what is trend following doing? And then does that deserve potentially to have an alpha? Because you can have a very interesting strategy that has no alpha if you just like the payoff profile of that strategy. So what is trend following doing? Well, there's a very close relationship between trend following and delta hedging an option straddle. And it's a little weird because it's like a look back straddle that was struck at a weird, it's not as clean as like an current at the money straddle. But basically, as price goes up, you're buying more, and as price goes down, you're selling more until ultimately you short, right? As you cross the strike of whatever that straddle is, you're increasing your negative delta, and you're buying more delta as it goes up. So trend following in many ways, and there's many ways to implement it, is either like a discrete or semi-continuous replication of this look back straddle. And so from that perspective, you're just trying to use trading to replicate the payoff profile, avoiding paying the premium for that option, but the cost is going to be in the delta replication, right? The whipsaw you have is really just the cost of delta replication.
Yeah, the restriking is similar to whipsaw effects, right? That's basically the...
Absolutely. And so from that perspective, I just say, well, ignoring whether markets will mean revert or trend, is that an interesting payoff profile? It's sort of like if you look at a diversified multi-asset trend portfolio, and I'm sure if the Resolve guys are still in the comment section, they're going to hate me for saying this, but I think if you look at trend and you apply trend following to all the individual components of a multi-asset, currencies, commodities, rates, and equities, it's going to kind of look like risk parity that you've applied a straddle to. Right? You get this very diverse, globally diversified portfolio. Typically, you're enforcing some sort of relative vol component on top of it to maximize your diversification within the portfolio. You've got target vol at the portfolio level. And then, you're sort of creating this bend to the payoff profile. And there's going to be a cost to that in the middle, right? Just like you would with a straddle. You're going to pay a premium. It's just that the premium is going to be in realized whipsaw. And so I think for many people, that's just an attractive long-term profile. Whether there's alpha to it is a totally separate question.
Yeah.
Right? You can like trend following and not believe trend following has alpha. Like that's not an incoherent view if you find utility in the payoff profile. And so is Eric right that it's risk transfer, that you're providing a liquidity service? Maybe in some markets that may make sense. In other markets, I don't know how you can defend that in rates and equities, right? It might be a commodity market thing.
No, you can't. That's what I'm saying. It's more in CTA trend following or long ball. It's not in equity or bond markets. Is the risk transfer.
Right, but what I'm saying is like you're trend following equity markets, you're trend following rate markets in a diversified CTA. Different. Well, right? Then, so I think it's defensible. It's a sound good story.
Yeah,
I believe there is some alpha to be had there that has less to do with like a risk transfer. I think it has just more to do with exploiting rapid position changes, that when people get like tapped on the shoulder for a risk reason, that you're just there pushing the trend.
Which would be risk transfer services. And I was just making sure you weren't going to, I was just making sure you weren't going to go with a rebalancing premium and diversification premium.
I absolutely will not. Under no circumstance.
Part of it though, but that's why I always want to try to think about that though, in the sense like you're saying, if we have zero sum or negative sum game, who are the players involved? And the whole point is there's also this, you have to think of levels to this game, and the actual producers that are hedging their exposure, they're doing that in a negative sum way because they have a positive sum on their cost of capital. If they're hedged, then they can go to the bank and get lower cost of capital. So it's kind of like you have to think about what are the different wins, not even inside the market, it might be negative sum, but outside the market, it might be positive sum for the larger players. So you always got to worry about that. The other thing I don't want to rehash is kind of our, not your and I's ongoing argument, but around the horn ongoing argument that, the only thing I have a problem with the long straddle profile is that CTA trend following is not necessarily long gamma because nobody's really adding to their positions anymore unless they're running, multiple look back periods. And so they're layering into those positions, but that's so rare. So you don't really have the long gamma effects that you would get from restriking a straddle.
Agree to disagree. So you got multiple things going on. You got those people who are doing a single model, binary in or out. Yes, right. There are those people. You have other people who are using a variety of models, a variety of look backs. I would actually argue that's not really even doing the straddle thing correctly, because all that's doing is it's like sort of doing a bunch of straddles. You're discretely replicating a bunch of straddles. But those that are attenuating their signal based on volatility, right? So you're doing sort of a look back of how strong has the trend been, dividing by something like vol, realized vol. That is almost exactly what delta would be if you were to do the options delta. And so if you're having some sort of continuous signal that changes based upon the relative strength of the trend to the vol, you can sort of think of that as like signal to noise. You are very closely delta replicating, and there are those trend followers out there. But yes, broadly speaking, I do think you're probably right. Most people are just discrete indicators on or off or short, which is sort of now you're discretely replicating. You're not sort of continuously replicating. And that's just going to add to the whipsaw, or it's going to add to the replication noise. Like in some environments, it means, your delta was a 0.3 and you just went full into your position. And maybe you front ran the trend and you actually outperformed what would have happened with delta replication. Other times, maybe you put on that full position and you get whipsawed when in reality, you should have only had 0.3 of a position. It's tough to tell how that stuff plays out over time. But yeah, look, again, it's a coarse delta replication.
As per usual, we're both right, or more importantly, we're both probably wrong. Is that you and I like to we're talking about nuances and degrees that nobody actually cares about. And even in the comments,
I care deeply about this stuff.
Well, no, we both do, but I'd say nobody else does. In the comments, On said that index fund is like trend following. P is a trend following strategy, but I would argue actually that there's plenty of research and a lot of people know this. It's actually a momentum strategy, but like that's I kind of well represented in the literature that just the way the index is constructed and actually not even market cap weighted but floating cap weighted, you're inevitably going to have momentum strategy within the structure of that. But there's one thing you touched on.
I'll disagree there in a weird way.
Oh, please.
You want me to disagree?
Yeah,
by definition, momentum is measured versus the market cap weights. So you can't have momentum in the market cap weights because the market cap weights are what momentum is based on.
Fair.
It's beta. By definition, the market cap. Yeah. That said, yes, what most people mean is if you buy the index today,
survivorship,
you're buying more of the stuff that went up yesterday and less of the stuff that went down yesterday. So yes, from that perspective, from a flow perspective, flows are tracking a sort of pseudo momentum strategy.
And then I wanted to bring up, because when you talked about the delta replication and then the implied volatility variable in there, is one of the things I constantly bring up that tends to get crickets from the CTA classic trend following community is, they like to argue whether you should be, vol targeting on the back end after the trade's open. And they argue about this ad nauseum for no reason, just because they love to pick fights with each other for no reason. But the one that I really focus on is, as you know, all of their initiation positions are vol targeted. They're vol weighted usually on ATRs, right? And so as volatility expands, you're going to have a lower positioning sizing because of volatility expansion. So specifically why I bring that up is after volatility expands and they go, well, we can short the market indices around the world. Well, your position sizing is so small when you're shorting the stock market indices because vol is already expanded. Does that really help the portfolio being on the short stock market side of these indices? I mean, obviously if you can catch it before vol expands, but it's not likely your signals are going to get you in there before vol expands, and then you're attenuating your position size to vol. This is one of the ways where that can actually hurt you.
Yeah, so Cam Harvey and Man Group has a great piece about what target vol does for different asset classes. And the real key question is, what's the covariance between volatility and forward returns? Equities tend to exhibit a negative covariance. That as vol expands, forward returns tend to be worse. And so what that means is, if you are doing a target vol strategy, it is a pseudo trend strategy. You tend to be decreasing position size as returns get worse and increasing position size as returns get better, because realized vol tends to go down as market returns are more positive. That is not true in other markets. And
Right.
so to your what's interesting in particular about thinking about the equity contribution of equities within a multi-asset trend strategy is that historically they contribute very little. Like, people look back to 2008, it was not shorting equities that made trend followers a lot of money. It was long rates, currency, commodities. It was
And not till
not
Q4.
equities,
It was long
right?
bonds in Q4 saved their bacon. Yeah.
And because, to your point, what happens is vol in equities gets so big that even if they are short, that position size gets squeezed to nothing, right? You don't get more negative. It's like the position size. So the contribution of that position from a vol perspective, maybe is contributing as much as rates, but it doesn't really work out that way. And so historically, equities have actually contributed very little in return to multi-asset trend followers. But it doesn't mean that they're not potentially useful just from a diversification perspective and smoothing out the overall portfolio returns.
All of it's fair as always. Fair and
Yeah.
balanced. Corey Hostine.
Okay, but so I wanted to bring up trend following for a totally different reason.
Okay. I had plenty more
Right.
questions, but you go ahead and
I
jump in.
know, but I wanted to bring it up for a totally different reason, because we are now entering the era of product chasing. That trend following is now interesting again, and we're going to see a lot of trend following products come out. And I have seen some products getting discussed that are based on bank indices. And so, for those who don't know, there's a lot of quantitative investment strategy groups within banks whose job is to create, ideally, interesting indices that capture trade ideas. And there's one in particular that caught my eye recently, because it came out a year and a half ago. It's sort of the newest bank index. Most of these banks already have these from a decade ago when it comes to multi-asset trend following. And if you looked at the returns of this, and I'm not going to name and shame, I'm just going to keep this very anonymous because I want this to sort of be a teaching lesson, not about shaming. If you look at this index's historical track record, that's a back test, it absolutely obliterates all the other trend following indices from like 2000 to 2018, which is around when it went live, and then completely underperforms them in the live period. And I bring this up because I think there's sort of two things here that I want to point out. The first is actually, I think there's, for those who are young quants that want to learn, if you can get access to bank research and bank literature and try to replicate these indices, I think there's a ton you can learn, because you can learn about how they think about how they're building these portfolios. And typically, like, they'll have built them 5 or 6 years ago. Then you can sort of hypothesize how you think it will do out of sample. And then as you watch them come out live, as you see this research get published, you see that there's this like sort of interest chasing aspect, that people get interested in a topic and then banks publish the research a year later. And typically it's not, and I don't want to insult the banks here because I think there's some very brilliant people there. But typically it's not with a huge amount of consideration as to why the trade exists. It's just packaging up the trade mechanically into an index, because that's kind of what they need to do to sell structured products and that sort of stuff. So I think for young quants, if you can get your hands on old bank literature and try to replicate those indices, I think it's incredible practice. It'll really build your intuition around strategy design. So that's one half. The second half is that when we talk about something like trend following at this point is so well established that I don't consider it alpha anymore. Right? I think there is this idea that like something that no one really knows about that you can exploit in the market, that's alpha. And over time, as more and more people become aware of it, it sort of transitions out of the realm of alpha to maybe like esoteric beta and then maybe like systematic beta, and then it just sort of becomes like common factor beta. Just becomes like there's not necessarily even a premium there. It's just sort of explaining returns. I think trend is much later in that cycle from alpha to like factor beta. I think it's just sort of like more factor beta, which means that no one should be publishing a backtest nowadays that has all of this undiscovered alpha in it. Like the fact that someone published a trend, multi-asset trend following backtest that like obliterated all the live indices is a massive red flag. It's like
the burden of proof should be incredibly high, right?
Yeah, like this stuff has been around for 30 years and it's very vanilla the way it's implemented. So like you need to explain to me how suddenly you discovered all this amazing alpha. Was it in your signals? Was it in your portfolio construction? Was it in the contracts you chose? Like what was it that everyone else missed this and somehow you're printing 5% alpha per year compared to the benchmark? And I think the more not vanilla, the more like well-known something is, like the more burden of proof there is. Like if someone publishes a value index today, like a value stock index, and it obliterates other well-known value stock indices, like that's a red flag to me. That's not a good thing. That's a bad thing. Like you shouldn't be finding new alpha in value. That to me says you just overfit it. So like that's my spiel. I'm done.
No, that's perfect. Every time we do like you said, it's got a high bar, but then when you're saying go back and replicate the bank's research, I was thinking of this like behavioral economics. It's non-replicable, or like cohort studies or any sort of nutritional data or studies.
It could
like,
be hard to replicate. They're not always transparent in what they do.
But along those lines, you made me think about because actually I'll pull an example from real world today that's slightly similar yet tangential. And I didn't even think about it till you brought it up. Is the homie Ben Eifert had a nice tweet thread about non-stationarity with a lot of these backtests and then walk forward, how these strategies tend to fall apart. And it was just so funny. I was talking to a machine learning firm that uses neural nets and all that stuff today. They're using all their fancy black box terms and everything. And then he throws in there, he had a line in the middle of a sentence about non-stationarity. And I was like, hold on. Let's go back. The key phrase in that entire thing was non-stationarity, right? It's almost like dark matter, right? Or emergent properties. It's this catch-all phrase that we use for I don't know, right? And if you can't pick up on that and that you don't realize that that's what that phrase means, that they have no idea if this is going to work on a walk forward basis because it's a black box due to non-stationarity of any replicable data from past returns into a walk forward, actual trading in real time. Like that was, I always like to draw out where the emperor is wearing no clothes. And that's what you have to worry about is non-stationary principles in finance. This is not a Luddic fallacy, right? Like this is not a closed loop system like Go or chess. You can't necessarily figure it out. It's complex, integrative complexity on integrative complexity with people moving in different directions at all times and in all ways. Like it's just like the games and the rules and the parameters change on you on a minute by minute or day-to-day basis. And especially you and I know this from vol space is like those vol services are constantly undulating and the regime shifts every 2 to 3 years. And quite frankly, this year it's changed every quarter. Like it's just it's not something you can count on into the future. And you go, well, I have a 10-year backtest in vol. I don't care. Like it's totally irrelevant.
Right.
Like even
if it's not a backtest, even if you've been trading it live for 10 years, the question is why is the current regime like similar? How is it similar or different to the prior regime, right? Post 2020, a huge amount of vol sellers and variance sellers blew up. How does that change how vol is going to be priced going forward? There's a massive new demand for vol in products that are coming to market. How does that change the opportunity set? Because to your point, this is an adaptive regime. And it's always adaptive in a good way. Like, again, people are always sort of fighting the last battle. You see the appetite for tail hedging strategies emerge with like fierce power post 2020. But to pretend that that's not going to have an impact on the vol surface and the way vol is priced and the available convexity in the market, arguably post sell-off, like when there's absurd demand for protection, you probably want to be selling vol, not buying vol. And yet the reality is most people are going to try to go buy protection. It's sort of like buying insurance for your house after it's already burned down. Like, no, that's when you can charge fat premium.
Exactly. When it becomes a player on the field, so to speak. So going back to some of the more trend questions, one of them, I'm curious your take on this, is the strength of the US dollar and then that's correlations with commodities being priced in dollars. Do you think it's become one big dollar trade right now, and we have to wait for some movement in the other direction for dollar for commodity price to move, or do you think it's really just a long dollar trade that everybody's trying to trend follow on?
Yeah, this is one that's come up quite a bit because if you look at like the SocGen index, and I'll use DBMF as sort of an easy daily tracker there, the ETF, the correlation to what's happening in rates and the dollar and the energy complex like has been high this year. And it seems like there's been like a single convergent trade, and it's hard to know what's leading and what's lagging necessarily. And I don't actually have a strong view there, right? But if you actually try to break down what is driving trend following returns, like they have been super long the dollar all year. They've been super short rates. Commodities actually were a big driver earlier in the year. They don't seem to be a big driver. There's like a lot of those positions have gotten a lot smaller in the second half of the year. So it seems to be a big rates dollar year. It's a question of like, are rates driving the dollar, or is the dollar driving rates? That's for macroeconomic tourist answer, not me. I don't have a strong view there because
what, this isn't a macro show?
I know.
I thought I thought we were discretionary macro traders, but like I want to actually come back to the DBMF.
In my PA, I am, but I won't tell you what I'm holding.
Well, and this is an epic setup for you because like we both hate global macro. We both can't predict the future, and these questions are kind of global macro. But I'm throwing these off the top of your head where you have no idea what I'm going to ask you. So I just like to see your hot takes on it.
Yeah, this is me on a panel here. Wait, but
yeah, exactly.
I want your take. Wait, I can answer, but like, what's your take on that? Right, you've been you. I know. We got to be a little careful saying what we do for our day jobs here.
Let's back up.
But you allocate the CTAs. You see the positioning the same way I do, right? Yep. I would suspect like there is some diversity in the way that they have been positioned, but predominantly my suspicion would be if you were to net out all those positions, they've been very long dollar short rates this year. That's just sort of been the trade. I think some people like Michael Harris and I were going back and forth on Twitter right before the show. He was saying, you look at SocGen CTA index, it's totally just basically been short rates this year. I said it was more long dollar than short rates, but both incredibly powerful explanatory variables. Is that a risk that if all of a sudden that single trade reverses, they're so like the amount of, I'm going to use a statistical term, but like the eigenvectors within the portfolio, the amount of diversity they have in their portfolio has converged. Like they are, it's multiple trades all expressing the same view. And is that a risk to CTAs nowadays? If all of a sudden Fed pivot, rates drop, dollar drops, like they're all on the same side of the same trade with multiple expressions.
No, that's a great way of putting it. And you actually transitioned perfectly in what I was going to talk about next. And that's like, when I look at managers too, you start asking about what their sector weights are, right? And a lot of times for most of them, it's like a lot of times, more often than not, you see like a quarter each, right? In equities, fixed income, commodities, and then they might delineate softs and everything out of their FX, so it's like what is the exposures, but then you start talking about sector weights and then you realize, wait, what if this is just really a long dollar short rates trade, right? Like even though you think you're diversified, you're not. But what we're going to get into, I think that's even more interesting than that maybe people aren't thinking about, or maybe they are, is the idea of how many instruments you trade. So it's been interesting around this DBMF, and it's been fascinating seeing Andrew on a lot of the podcasts these days, is, does correlation equal performance, right? Even though it may be highly correlated with other trend followers, does that manifest in performance, which is one question. But more importantly, does it matter how many instruments you trade? Because as you know about DBMF, they're trying to trade the 10 most liquid instruments, and they're trying to replicate most of the trades there, right? Classically, a lot of those managers are trading 50 to 60 markets. And then now you have even more modern managers are trading hundreds to 200 markets by creating synthetics. So once again, like, are you really getting broader diversification that way? Does it aggregate up to like a long dollar short rates trade? Or more importantly, this is what I'm saying that people don't talk about, is even if a CTA says I trade 50 to 60 markets, well, they're only trading so many markets that trend, and then they're ATR weighting that position. So they actually only might have on 4 or 5 trades. So when they say I trade 50, 60 markets, it's really 4 markets. And then that's going up and downstream. You tell me what you think.
No, I think Mount Lucas had a post about this the other day where they basically said when you trade that many markets and you catch a trend, does it even matter? Right? Do you have to sort of limit the markets you're trading? I think there's probably a mathematical way you can look at this and say, yeah, you have more. If you think all of these markets trend with equal probability, then I think it all sort of nets out. Like you can have fewer holdings that are a larger impact or more holdings that are lower impact, but the same proportion of your portfolio is trending. And actually, you'd want to be more diversified for sort of geometric growth reasons. So I think there's probably a mathematical argument. I think what really matters here, and Adam Butler at Resolve wrote a great post about this a while ago about constructing maximally diversified portfolios, is not thinking about this in terms of markets, but thinking about this in terms of unique bets, right? Yep. And this is something like us quants think about a lot, is we would look at something like the covariance matrix and decompose it and say, well, how many unique bets are really in here? Like if you've got two assets that are 99% correlated, like having both of them doesn't really add any value from a diversification perspective to the portfolio. And I think that's been Andrew Beer's contention, is that if you only trade, call it 15 markets, but you're selective about which markets you trade, you can actually capture a significant proportion of the true number of diversifiable bets within a 50 market portfolio. Like if I were to look at the covariance matrix of that 50 market portfolio, there might be only 10 truly unique bets in there. And the rest is sort of, potential beneficial diversification, but it's also higher trading costs, more operational burden. Andrew's argument is, look, I can trade 16. I think he has 16 in the portfolio.
No, I thought it was 10. So you think it's 16 now?
I think it's 16. I think it's 16.
No, that's because I don't want to misquote. But speaking of Adam's thing, I almost quoted Adam the other day, but I also didn't want to misquote him. So if Adam's is still in the comments, he can comment himself. But maybe you remember, did Adam say there's 13 or 17 unique bets among like that 50, 60 manager, classical manager?
Yeah, I mean, it changes over time, right? So this is coming around to my full point. There's certainly a lot more in that than say 500 equities in the S&P 500, right? The number of unique bets in holding 500 equities might be 2 or 3. In a 50 market futures portfolio, you might have 17, 18. But in a year like this,
which one's trending? Yeah, which ones are trending, and then are you long or short on those trends?
Which ones are trending, but it's also like the amount of available diversification waxes and wanes, right? So it might be in certain market environments, they're all acting very independently. The dollar may act nothing like rates, may act nothing like commodities, but this year where it's the fundamental driver may be inflation that's causing a Fed reaction. I know you hate talking about this stuff, but that might cause a convergence of multiple independent bets into one bet.
Yeah.
Right. That it's causing the market to reduce the amount of available diversification. So in such a situation, Andrew's portfolio might be able to exploit that, where he's only trading 10 to 16 that are giving him the diversification. But there might be another market environment where there's huge diversification available in some of these other futures markets that he's not trading, that he might miss a lot of the alpha. I don't know. He claims, and I told him he should write a paper about this, and I trust him at his word because I know him, that it doesn't really matter, that they've done a ton of subsample analysis, that if he chooses these different markets, as long as he has like a major commodity, a major precious metal, major rates markets, major currency markets, he can capture the majority of the index. And he can sort of sub them in and out. If he were to totally forego commodities, he's going to miss something. But does it, if he's got oil and gold and the major rates markets and the major currency markets, like he's basically saying he's covered the basis of the diversifiable set.
Now that we're deep diving down into this, I want to pull on maybe even 2 sub niches within this. And one of them we've already probably talked about a lot on the show, I think, is like, the other thing is in an environment like this where trend following is crushing it and you have trades that are trending for a long time, like you're saying, long dollar short rates. Now you have to start worrying about your actual left tails, right? Like now that once you get, the more profitable these trades become in trend following, the larger you're opening up your tail risk and your left skew. Yes. And it seems perverse when you're talking about, like you're almost saying, replicating deltas on a straddle. It's like you're not thinking about your worst almost drawdown is ahead of you because this open trade profit. And how do you think about that? And that's where, quite frankly, and Andrew knows this, that where he can get really hurt is on the turns, right? Especially if he's replicating on just like one position.
Yeah, this is something that I think it takes running these strategies to know, right? It takes the experience of going, oh, I've got a big open position, and I'm running something like just a simple 200-day moving average crossover as my trend signal, and wow, the distance between what I have and when my trend is turning off is 20%, and I could give back 20% of this position when it turns. It's the same thing with options, right? You buy an option and you think it's got a ton of convexity, and when you're right about like the directional trade, you lose convexity and the amount of open risk gets higher. Like the position gets riskier the more correct you are. And I
Start
think
getting a
that's
delta one position. Yeah.
right. It becomes delta one. And so all of a sudden you become massively sensitive to what's happening in the underlying. I think that's exactly what happens with trend following as well. That said, there's a lot of trend followers who build attenuation, right? Where they actually, as the trend gets overextended, reduce the position size for that exact reason. In a weird way, it's sort of like a short-term mean reversion type strategy. But trend followers are very aware of that. They try to account for it in different ways. Some just say, I'm ignoring it and I'm well diversified. Others say, I'm going to explicitly build signals to acknowledge that when I have that much open risk, I actually want to take the risk down.
And then another one of the deeper nuances with these trades that we haven't talked about is term structure when you're trading futures, right? And I know you like to follow a lot of the bank's research, maybe for what not to do. But one of my favorite research tools is Quest book when it comes out and just seeing all those pages, charts that Quest puts out that are so great. And one of them that caught myself and especially my partner, Taylor Pearson's eye, was short-term demand is leading to steep backwardation in most managed futures markets, which is creating the highest roll yield since the early 2000s. So the question always is on trend following. Are you trading in the trend in the way of roll yield when we're in contango or backwardation? Or how do you worry about putting on your trending trades? And do you worry about the term structure at all? Because then are you making money off a roll yield or are you making money off a trend?
There's a great paper out there that anyone who's stuck with us this long that cares about this stuff. There's a great paper there. I think it's called Trend and Carry or Carry and Trend. And I think it's by Koijin. I might be wrong. But it's a great paper that talks about some of these carry effects, like roll down, roll yield, and the conditional impact on trend following. And I think it's an interesting question as to, do you ignore it or do you incorporate it? And if you incorporate it, are you a pure trend follower anymore? If people are buying you as a pure trend follower and suddenly you're a trend follower that conditions on carry, how does that change your return profile? And how does that change how people who are allocating to you should think about you? Because I think once you take that step, right, and you go, actually, I'm a trend follower that conditions on carry. Well, then why are you only looking at carry? Why aren't you also looking at seasonality and short-term mean reversion and relative value? And suddenly you're a systematic macro trader, right? And I think just candidly from like a sales perspective, you need to live in one of the worlds. Living in that halfway area, I don't think suits anyone. You're unlikely to get the pure allocators who want the pure style, and you're not going to get the diversifying allocators who want as much diversification as possible. That's just a kind of a shitty place to live.
Or and then how much do you want headwinds or tailwinds, and that's part of the process as well. The other reason, obviously, we're talking about this, the other thing that jumped out at me this week was the research that showed rolling 3-year correlations on stock bonds have turned positive for the first time in 2 decades plus. So that's obviously why we're talking about trend, but it's also why trend is hot. So along with those lines, my real question too is like, when trend starts getting hot, and I've seen performance chasing in our funds where people want to talk about our trend fund, right? Is like, how do you start worrying about capacity constraints if we see a flood of money coming in like we saw post 2008? But isn't it a little more nuanced than that? They started coming into like the Goldman Sachs of the world and everything that were just like long only commodities or not really trend following commodities. Like, how do you, like you said, this is a pretty vanilla strategy, but like, what are the capacity constraints when you're trying to trade 50 to 60 markets?
Yeah, I mean, I think this is something that happened post 2008 with CTAs. I think the space went from something like 150 billion to 400 billion. It's now somewhere around 350 billion, 300 billion, probably growing again is my expectation.
Yeah.
And you could sort of see analytically that the average trend length got slower post 2008. I think those two factors. One, 2000 and 2008 were both periods where slower trends worked really well. And two, it's a capacity issue. Just if you're moving that much in assets, you can't trade quickly. The T costs are too high, the impact is too high. And so you are forced as an allocator to slow down. What that means is your prior track record becomes even less relevant. Right? And that's the question allocators need to have.
Right.
Is if I'm allocating to you today and you triple in assets and you keep trading, how is that going to change the way you're trading? If it's not going to change it, prove to me, right, that you're not going to have impact issues. But if you're going to slow down so that you reduce your impact, you're going to go from a 3-month trend signal to a 6 or a 9-month trend signal. Well, that's a very different return profile. The convexity that type of strategy is going to exhibit is going to be over a much longer period. Right? A 3-month trend, you might get convexity over a 1 or 2 month sell-off. 9-month trend, no, that's not where you're going to exhibit convexity. And so you have to be very aware as an allocator as to how those things are going to change. Look, at the end of the day, these futures markets are not infinitely deep. And the more people who get on one side of this trade makes the trade less attractive. It can make the trade run, but then it becomes a front running game. Like it might make trends last longer if you've got a full breadth of trend followers across multiple horizons. But what gets interesting to me is the more people who adopt commodities and trend following, I think congestion strategies get interesting. Looking at things like what's happening in the curve and trading longer versus shorter dated futures, looking for congestion, I think becomes a more interesting trade.
Well, that's a really interesting way of looking at it. But also, don't you think it's like it depends on where the money floods into, right? If it's flowing in just to commodities or long only commodities, that could help trend followers. But if it floods into trend followers, then you're aggregating larger capacity amongst these strategies, and then you have the combustion trade, which is a fascinating way of looking at it.
So here's where I smell a new fund with all this.
Maybe, oh, yeah, please.
Maybe here's what I thought you were going to go with all this, which is like have people miss the trade. And that's a question I'm getting all the time, right?
Yeah.
I've lamented this in the past. I tried to put DBMF in my models at 40 million. Everyone told me it's too small. It's now over $1 billion. Everyone tells me it's too big. And that was a year ago, right? I've talked about this on past episodes. And now people are saying, Corey, I know you've been a proponent of managed futures. Managed futures are up 30% plus this year. Have we missed it? If we allocate now, are we going to get the mean reversion? And I get the fear, right? Because allocating now in a meaningful size is a big trade-off, right? You are effectively market timing. If I have a 60-40 portfolio and I sell 20% of that to buy managed futures, I'm effectively implementing a long managed futures, short 60-40 trade.
Yeah.
And that's like, there's a lot of tracking error to that trade. So the question, Jason, is, okay, people who don't have managed futures that are interested in putting managed futures in now, are they too late?
Well, I was just laughing because you had to get it. It's a long short portfolio all the way down.
It's always long short all the way down, baby.
So the way I think about this is maybe a little bit different. Like you're saying, I get a lot of the same questions too. And what's interesting is actually with trends is like how much longer can trends run? It's almost like a gambler's fallacy. You're looking at how many times red or black has come up and you're like, it's got to mean revert. There's no such thing that says it has to mean revert. That's a gambler's fallacy. So what I think it really belies the question of is portfolio construction. How do you put this in your portfolio? And where I think the perfect way to think about this comes in return stacking. But unfortunately, this week, it looks like we're out of time. So maybe like next week, we can talk about return stacking because I'm being joking, but seriously, like it matters like how you construct your portfolio. What's your allocation size? That's what we're always getting down to. What's more importantly is like, what's your allocation size? What's the rest of your portfolio look like? What are you trying to offset? Where are your risks in your portfolio? Do you need trend following in your portfolio because you have certain risks that it can handle? Then what is your position sizing to trend following within that portfolio to manage those risks? And then what are the emergent properties of that portfolio on a correlation matrices, on a drawdown risk, on a volatility risk, your Sortino ratios? All of those things matter. And it's just not a yes or no question of have I missed out on the trend? Because there's impossible to know that if we're going to mean you and I don't know if we're going to have, is this commodity super cycle or we mean reverting next month? We have no idea.
But let's acknowledge the very real position. Again, I work with advisors. You got to make that clear. The very real utility risk that they have, which is if they have a client in a 60-40, they've ridden it down 20% year to date. If they make the change to managed futures now and the Fed pivots and managed futures suck and a 60-40 recovers, they've now hit their client both ways. They got the full drawdown of 60-40 and then they perfectly mistimed it. So there is a business risk for these advisors in making this change. You and I would argue like every day you should wake up and say, what is the optimal portfolio I want to hold today? Blank paper, try to get to as close to that optimal portfolio as possible with consideration of T costs. The reality is, even if we say we don't have a view as to what equities and bonds are going to do versus managed futures, like there is an asymmetry in the business decision that a lot of these allocators have on behalf of their clients. Like they are at this point arguably better off sticking with a 60-40 from a potential risk, because they're not going to be the hero if they put on managed futures unless this whole thing falls, another 30-40%.
Right.
So the risk is really against them making the trade at this point.
So thinking about the business risk, marketing risk, portfolio risk, all that stuff, I want to give a shout out to the homie Meb. He had one of the best analogies I've heard in a while this week, or the way to think about financial advisors, or how they should put this in their portfolio and how they should talk about it. And that's because on his podcast, he had Abraham and Jerry Parker. And towards the end, Meb brought up Annie Duke. And what's been fascinating is Annie Duke has become a darling of the finance world with all of her books and relating poker to finance. So everybody seems to love Annie Duke's books. So these financial advisors may be able to talk to clients through the Annie Duke's books and using the analogies from there. And her first book, is Thinking in Bets, which is exactly what like trend followers do, right? It's a position sizing and betting on different directions and trends and breakouts. And then more recently, what Matt brought up was beautiful, is like you just brought up earlier, is like sometimes when you have open profit, some of these firms start titrating down that position to worry about when it comes back down on them. But what they always have in place is a stop loss. So Meb brought up her latest book about quitting, and we're all ready to quit, but sometimes it's optimal to quit. And the best trend followers in the world are unemotional about quitting because they have those stop losses in place. So you can think about it in bets, you can think about it quitting, and you don't have to worry about all of your behavioral biases, because if you're doing this in a systematic fashion, you're forcing yourself not to fall prey to these different issues. And maybe that's the way that they can express it to their clients, and gives them a tool on the marketing side to be able to express these things and putting together a portfolio no matter what may come.
Yeah. The last thing I will add on this is I've been doing research on it. And what you do actually find is that the conditional returns of the trend following index is positive, statistically positive, after stronger runs of the trend following index. So the question is, does trend? Trend does seem to trend, which is sort of interesting, which would argue if trend is done well, it's actually still a good time to put on trend.
Oh man, you're killing me with long-term portfolios all the way down. Really, like trend seems to trend, but then like DBM is trend following the trend follower. So maybe you're managing
it's trend all the way down, baby.
So with that said, once again, none of this is investment advice. Please seek out investment professionals. He's Corey Hofstein. You can find him at C Hofstein on Twitter. I'm Jason Buck, Jason C. Buck on Twitter. Next week, we'll actually be live from the Cayman Islands. With the time change, I was trying to figure this out. It'll actually be on the same time as East Coast next week, right? Not that this matters to the audience, but we'll be at 3 Eastern next week. And Cayman should align with 3 Eastern, I believe, if after the Sunday's time change.
I believe they are back.
Corey,
Cayman does this weird thing. Cayman does this weird thing where they just stay. The rest of the world changes times around them, and they just stay. So I think now they are on Central Time, and they will be back to Eastern Time.
Well, isn't that what you should do when you're laying in a hammock under a palm tree? You should just stay and let the world revolve around you. But hopefully, allegedly, this is the last year with our time change, and everybody's voted it down. We shouldn't be doing this anymore. Thank God. Because I mean, who cares about? We have electricity now. So what are we doing? I know you like to sleep and wake up with the sun, but not me. Anyway, that's it for this week. We hope to see all you in the Booty Crew next week. Thanks for all the comments. Thanks for, as we whittled it down to one person, as we always tend to do, we start broad and make sure we get so deep in the weeds, nobody cares anymore. But with that said, Tyler, please roll the outro.